The next guest on the show is someone who in the first week of Jan 2014 was shouting, was insisting and was making a strong case that it's time to buy into Cyclical. Saurabh Mukherjea of Ambit Capital. Saurabh, congratulations, you were dead right. Cyclicals have seen a huge rally.
Thanks.
So what's next for Cyclicals now?
They have, and I think there's a little bit more left in the tank. There's a little bit more left in the tank, but I think as you're alluding to your previous guest, I think it does make sense, I would suspect, to take some profit on some of the names which have gone up, 50, 60, 70, 100% in the last 6-7 months. So a lot of the stocks that we were pushing very hard back in August, September, October have risen by 50, 60, 100%, and in some of them at least I think it's worth taking some profits. So for example, in Cummins India, we retracted our buy stance a couple of weeks ago. In Apollo Tyres, we retracted our buy stance earlier this week. In Voltas, we turned sellers earlier this week. So in some of the star names in cyclicals, the rally has been so steep that one can't but use some rationale and say it's time to take profits there.
Saurabh, what's the sense that you're getting about the overall market as well? Because of late, the market seemed to be more in a consolidation mode. Does it seem like this is going to continue up until the election result? Or do you think we could now get into a corrective phase as well?
I think clearly you'll now have a month, 5 weeks of very little news flow. The politicians can't say that much. The opinion poll season is now done. What you'll now see is a set of difficult results based on FY14 performance. But by and large, I think most investors out there know that FY14 results are going to be difficult. So I don't really expect the market to do a heck of a lot between now and the end of results. There'll probably be a little bit of currency-based action if the rupee strengthens on the basis of bond flows. But I think that the main thing you'll see is investors trying to pick up the cheaper small and mid caps. In a way, picking up quality mid caps which were cheap is already done. So an Apollo Tyres has done well, a Cummins has done well, a Voltas has done well. I think what you'll now see is investors looking for smaller mid cap companies which are one notch below on quality, but they are still cheap. So for example, I think a Shobha Developers, a Torrent Power, and those are the sort of names I'm looking at quite carefully over the next month. A Federal Bank, these are the sort of names I think investors will start buying, and in effect they'll use this as a call option on the elections. If the elections go as per the opinion polls are predicting, then a Shobha Developers, a Federal Bank, these sorts of companies will have another strong rally. And if the elections don't work out, if you're holding a relatively cheap company, your downside risk is modest. So in a way, the first flush of rally in top quality cyclical names is behind us. Now you'll see a build up in action in one notch below in terms of quality between now and elections, and then depending on how the elections go, you'll either see a further step up in risk post the elections, or you'll see profit taking in the months of May and June.
So, Saurabh, I'm just going to pick up 2 stocks out of the 3 stocks you mentioned because I tracked them. Shobha Developers and Federal Bank. Shobha Developers last week has gone on record and they've indicated, folks, we will not grow. We are revising our guidance, or FY14 guidance. B, for Federal Bank, the key challenge is the book quality is still a huge issue and their cost management is clearly not under control. So what makes you bullish on Shobha Developers and Federal Bank when there are challenges in the short term?
So I think one of the things we look for as a house is we look for management teams which are honest, which run relatively clean operations, clean in the sense that the company's cash is actually being used for running the company for shareholders' benefit rather than disappearing to other places. I think both Shobha and Federal, they have good management teams. We appreciate their candor, their honesty, and it's always good to see a company being fairly candid about what the future holds. But more specifically, let me just take Shobha to begin with. It's got the largest land bank of any developer in southern India. Over the last 3 years, southern India India has been the most promising geography for Indian real estate. Markets like Chennai and particularly Bangalore have been fairly vibrant. I don't see that changing dramatically. Yes, there is likely to be a lull in Shobha's outlay plans, but if you look at Shobha's execution over the last 3-4 years, the rate at which they've rolled out projects, the cash generation, their low debt equity, I think debt equity is only 0.5 times, consistently cash flow positive. There's a lot to like there. And in spite of all that, in spite of being the best developer in the most promising geography in our country, the market cap is below $500 million, which I find absolutely stunning. So if I look at it in a first principles basis rather than quarter-to-quarter guidance, I think Shobha Developers is something which one would have in their portfolio over a 1 to 2 year period. Even if one wants, even if one had a six-month profit horizon, I would still have Shobha in my portfolio. Moving on to Federal. They've done 2 sets of investments over the last couple of years which have dragged their ROE down. One is they've rolled out, 1/3 of their branches have been rolled out in the last couple of years. And if you roll out so many branches in a compressed span of time, it drags down your ROE. The second thing is they're an overcapitalized bank. They've got more equity than they need right now. So that also drags down your ROE. As you grow into the recovery, as you grow into a modest economic recovery in FY15, FY16, Federal's ROE will come back up to 12, 13, 14%, and I think the stock will re-rate accordingly. It's already actually done relatively well over the last 4-5 months, but I think there's plenty more to come from Federal. So 2 companies not in the pink of health, but I think plenty to play for there.
Saurabh, just want to come to you on IT because, soon the rigmarole of the IT earnings is going to kickstart with Infosys. While it's one thing that the managements have sort of warned against the quarterly, misses that they may have this time around, does it seem like it could be a deeper shock than what has already been warned?
I think my take is that the IT sector had a tremendous run August through to January, February, not just in terms of stock prices, but in terms of earnings tailwind. The slide in the rupee was an unprecedented tailwind. If the rupee slides so quickly in such a compressed period of time, it's a tremendous boost to IT sector earnings. All of us were taken by shock by that, and in a way the IT sector's stock price rally reflected that. But I think the market then overdid the rally. And my sense is what you see in this earnings season and the next is a pullback on the IT stocks. The companies will, I think, give sane guidance. Infosys is already guided down. I reckon the results themselves are not going to be anything to write home about. With the exception of HCL Tech and TCS, we don't have a buy on any other IT stock in our coverage universe. I think Indian IT by and large has probably had its best time in the sun over the last 6 months, and from now on in, it'll be back to business as usual, where the currency doesn't give you that much support. The cost arbitrage gradually shrinks over time, and hence the attritional warfare between the IT firms themselves, between the Indian IT firms, plus the Indians versus IBM and Accenture, the attritional warfare returns. So HCL Tech and TCS are our only buys in the universe. I really wouldn't recommend having that much IT in an Indian portfolio at the moment.
Tata Steel is at 411 rupees now. A late mover, but Tata Steel has appreciated very smartly from levels of 360, 375, 411 rupees, up about 1% for the day. Saurabh, even though China is a big issue, there is huge overcapacity in the entire global steel industry. Strange it may sound, but metal stocks are having a strong quarter, so to speak. Hindalco, Tata Steel, JSPL, all of them are up more than 15 to 20% from the recent lows.
I think what you're seeing in metals, which is worth noting, is underlying prices are improving in India. So I think in Tata Steel's case, their Indian prices, the prices at which they're selling in the Indian market, would have improved a couple of % in the quarter ending March. If you ally that with the fact that the Odisha expansion, the Odisha plant, which is, remember, the largest plant ever, that plant will go on stream soon. So, the call that the investor out there is making is over and above whatever might be happening to global steel prices and global capacity. The Indian market leader is finally finding their feet. We've had a buy on Tata Steel over the last couple of years. I have to confess it hasn't been the happiest experience having a buy on Tata Steel for the last couple of years. But I do think that going forward, it's worth having in your portfolio. I don't think Tata Steel will shoot the lights out in terms of outperformance, but given the balance of evidence as to where this company is heading and where the Indian economy is heading, I think it does make sense to buy Tata Steel today.
Saurabh, the one call that has really worked out for you has been Ashok Leyland, and you've been recommending that stock ever since it was at 15 levels. Stay put with it?
I would say so. I think you're seeing a couple of things happening there. You're seeing new management, new CEO, new CFO. Vinod Dasari as CEO has got a stellar track record previously at Cummins and before that at Timken. They've got a new CFO from Thermax. So we're finally beginning to have faith in the numbers that the company puts out. I think in their 31st March numbers you'll see consolidation of their subsidiaries, which hadn't been happening before. So that's the kind of accounting side. Governance and accounting, I think, is a definite improvement from what it was 6 months ago. And then we come on to the more fundamental story about the capacity that they installed over the last 3 or 4 years in Uttaranchal, the HGV capacity, the LCV capacity in southern India, the tractor JV. I think all of those are actually good investments. They invested in sensible plants at the right time. And I reckon if the Indian economy recovers over the next couple of years, Ashok Leyland should be the beneficiary of that. A disclaimer here, Ambit does have Ashok Leyland in its own long-only book. Ambit Holdings has Ashok Leyland in its long-only book. So one disclosure that there is a house position in this stock. We've had a buy on it for the last year and a half. But as you're rightly pointing out, in the last 6-7 months, it's absolutely rocketed. I reckon if I look at Ashok Leyland over the last 3 cycles, from the bottom of the cycle price, which is around 15 rupees, to the top of the cycle price is at least a 3x expansion. Just look at Ashok Leyland over the last 10-15 years, it's a similar pattern. Bottom to top is a 3x expansion. On that basis, this stock should go to somewhere around 45 over the next couple of years.
You've given me a cue for my next question, Saurabh. What else do you own in your house book?
So we have DCB. Ambit has a large position in DCB. I think we own around 4.9% of DCB. We've had it for a while. Very similar story to Federal Bank, I would say. Well-run bank. Murli Natarajan took over the bank around 4 years ago. He has gradually turned it around. The ROEs have gradually improved. Cost-income ratio is coming down. But I think that there's plenty to play for DCB. If you look at DCB's cost-income ratio, they're still at, I think, 62-63% compared to, say, 48% for an HDFC bank. So simply by utilizing their capital better, by growing the business without growing costs as much, DCB can become a 15-16% ROE bank, which should take it to closer to 1.5-1.6 times book. So good bank, well run by a CEO who took charge 4 years ago, and that's the premise on which we built the position. We also have Ambit also has some Sun TV. We don't cover the stock, but the premise for having Sun TV is it is the dominant player in southern India. Has been the dominant player in southern India for a long time. And as the media cycle turns, one presumes Sun TV will be a natural beneficiary of that.
3 stocks now. The book has to be bigger than that.
There's a few other stocks which I can't talk about, but these are the ones which I've got some freedom to talk about.
Why DCB? Because in the financial industry, in the banking industry, size does matter. It
does, but I think if you look at the tone and tenor of how the new RBI governor is trying to shape up the sector, he's trying to make it easier for entrants to come in. He's trying to make it easier for the smaller guys to compete on a relatively level footing with the larger guys. And I think he's also trying to bring about a change in the credit culture. So I think in February, Raghuram Rajan and RBI published two directives in February, 2 directives aimed at the banks, which didn't get as much press as they should have. But those directives were quite fairly and squarely aimed at improving the credit culture in our country, improving at making sure that the banks across the system started sending warning signals to promoters who are falling 30 days, 60 days behind their payments. So in an improving regulatory climate, with a governor who's trying to now focus on the credit culture in our country, I think smaller banks have got a more level footing than they've had in the last 4 or 5 years to compete on. And remember, we are a grossly underbanked country. As is evident from the new licenses, it's not as if the RBI will suddenly back out lots of new licenses. So if you are a smaller bank, if you have access to capital, you have a good management team, I think India is a really promising place for you to operate in. DCB has all of those. Federal Bank does as well. Federal is much bigger than DCB, and hence our perspective was in terms of growth potential, in terms of the growth runway, DCB being the smallest listed bank has the greatest growth runway. So if you wanted to look at it very simply put, DCB is the smallest listed bank, the greatest growth runway, top class management team, well capitalized business.
Just by the way, in case you're wondering why the BSE prices are not getting updated, there's a quote coming in from Reuters saying the prices on BSE not being updated because of technical glitches. This happened on Monday as well. Seems to be a recurring problem of late. But Saurabh, what's your view on cement? Because a lot of people are now betting big on not just infrastructure, but the fact that, you know, construction activity as well is going to pick up and there will be demand for cement as well. Anything that you like out of the cement sector?
So around 9-10 months ago, we turned sellers on the sector as a whole. We believe that the big boys in cement had a great run, and it was time for our clients to take profits in that. But what we have stayed buyers on throughout in the cement sector were the smaller regional players. So Ramco Cements in southern India and Shree Cements in northern India are the two players we believe still have significant upside left. Both Ramco and Shree trade at meaningful discounts to the sector. So if I look at it on a EBITDA, EV per ton basis, both Ramco and Shree are on significant discounts to the peer group, something like 20 to 30% discounts. So regional cement is the way I would play the recovery in demand, rather than the pan-India players. Ramco and Shree would be our top picks in the sector.
India Cement, I mean, the stock is underperforming not because of performance or delivery, it is underperforming because of cricket. The fact that they own Chennai Super King. Do you think India Cement could be a good contra buy?
I think you know our house style, you know how we go about picking stocks. In that context, there's very little we can add to the view out there in the market on India Cements.
Ambit flagged off a very interesting report on Infosys. I want to discuss that report at length with you because you're the only corporate house who believes that there is a governance issue with Infosys.
I think it's a report on the IT sector as a whole. Infosys is one of several IT companies mentioned there, and you know, to be fair to us and to be fair to the company, there isn't anything in that report which hasn't been said before. I guess we are the only people to put it as simply as it has been put in our report.
But let's talk about core valuations for IT. Now, large cap IT stocks have already corrected by about 15 to about 20% from the recent highs. Valuations for a Infosys or for a Wipro, they are not all that stretched. So do you think at the current juncture, IT really offers a decent risk-reward ratio? It may underperform for this quarter, but ultimately attractive valuations will bail large cap IT stocks out, because if you're buying into IT now, you're buying a good quality business which is available at a P multiple of 12-13 times.
I think it looks like a PE multiple of 12-13 times on growth prospects, which over the next couple of years I reckon could be seriously questioned. As we've been saying over the last several quarters, the ability of firms like Infosys, firms like Wipro, to capitalize on the next wave of spending in Western IT is somewhat questionable. So the whole trend around social mobility, around cloud, around apps, it's not clear to us that firms like Infi or Wipro are well placed to capitalize on the whole wave of what we call SMAC. And in that context, even if the Western economies recover at the pace that many Indian IT analysts are expecting, it's not obvious that the benefits of that will flow down to firms like Infi and Wipro, and hence the persistent sell stance on these companies. The reason we like HCL Tech is what they've done in remote infrastructure management does give them a very strong position in a space in the IT industry which is only likely to grow even further. They've built a world-class RIM practice which we think puts them in a very strong position. Similarly, TCS in outsourcing, they've become a gorilla in the outsourcing space. Both of these firms, HCL Tech and TCS, have focused on a specific segment, invested heavily on it, and are reaping the benefits. We haven't quite seen a similar bet, a big bet from TCS, from Infi and from Wipro.